Welcome you all to Make It Simple channel. After saving our video, just like our video and share with your friends. Mainly subscribe to Make It Simple channel. In this video, we are going to see what are the types of bank charges are there. Bank charges are nothing but when a bank give loan to a customer, okay, the bank will charge some fee for giving the loan. They will take some security. If you are not paying any loan, bank has some security, so that if you are not paying the loan, the bank will recover, they will get the money from the security which it had taken before giving the loan. If you have paid the loan, they will give back our security. Okay, there are different types of bank charges are there. They are pledge, hypothecation, line, assignment and set off. Here in this video we will see one by one what these bank charges are. Okay, now we will go into the video. First we will see what is hypothecation. Okay, suppose you want to purchase a car. You are taking a loan from a bank and you are purchasing a car. Now this car, now the bank will take this car as a security until you repay the full amount. Okay, mostly this hypothecation is taken in the case of vehicles. So now this car or auto, they will be written as hypothecated to bank. Okay, the bank is taking this vehicle itself as a security. So until you repay the full amount, this is under the control of the bank. So monthly you will be paying the interest and the principal amount to the bank. Suppose in the mid before completely paying the amount, you stop paying the loan to the bank. Now what the bank will do is the bank have the control over the vehicle which you have bought under this hypothecation. Now here we have taken the example of car. So bank will sell that car and recover the remaining money which you have to pay as a loan. Okay, that is in the case of hypothecation. This hypothecation is mainly for the vehicle loans. Okay, next we will see what is pledge. The pledge here is when you want a money, when you take loan from the bank, you keep jewel as a collateral or jewel as a security in the bank, and keeping the uh, gold as a security, you take the loan. Okay, this loan amount depends upon the amount of gold you keep. Now there's two parties, okay, bank and the borrower. So the bank here in this type of loan, the bank is known as pledgee and the borrower who is taking the amount is known as the pledge. Okay, so this gold will remain in the bank until you repay the loan. Okay, bank have the full rights over this gold or any goods you keep. You are taking example as a gold, so full any goods you keep. Okay, so they will be bank will have the full rights. So if you are not repaying the loan, they will sell off the gold or the goods which you have kept as a security or a collateral, and they will compensate the money which you have to pay by selling those goods. Okay, next is mortgage loan. Okay, now you take a loan from a bank, and what you are keeping as a security in the mortgage, you are keeping the property, that is immovable property like house or any building you are keeping as a security and taking the loan from the bank. Here the loan amount also depends upon the property which you keep. Okay, you take the loan and you pay the interest periodically. So if you're unable to pay the loan, bank would recover the money by selling those property. Here the mortgage loan, this security which we are taking it as immovable property. Okay, so bank have the full right over this property. Now we will see what are the differences between mortgage, pledge and hypothecation. First we will see in these type of loan what are the securities we are taking. First what we have seen the hypothecation. In case of hypothecation, we are taking vehicles. Okay, so they are movable, so movable properties we are taking it as a security. In pledge what we are taking, that is also movable, some goods, jewels. Okay, so that is movable. In mortgage we are taking the property. Okay, the buildings or house, that is immovable property. Next, the collateral which we are keeping, it will lies with the borrower or a lender, that is with a customer or the bank, we will say. In case of hypothecation, the car is with the borrower, the vehicle is with the borrower customer. Okay, in pledge, the gold we will be keeping it in the bank, so that remains with the lender. Okay, in case of mortgage, the building, we can take loan for a building which we are residing also. Okay, so usually that these will be that what we are keeping as security, that is the immovable property that remains with the borrower or the customer. Okay, now we will see the examples in hypothecation. We have seen already, we will usually takes for the vehicles, so car or any vehicle loans. For pledge, what we have seen the gold or some certificate, national savings certificate also we can keep, or goods also included. In mortgage we have home loan. Okay, it's a quick recap of mortgage, pledge and hypothecation. Here now we will see what is line. Line is nothing but the lender's claim or the lender's right to sell the collateral which the customer or the borrower had kept before taking the loan. Okay, they are, this line proves that they have the bank have the lenders have the full right to sell those property. Okay, they don't want to get the permission from the borrower or like that, so lenders have the full right, that is the line indicates. Okay, well, some as we have seen, when we take a loan we keep some security on the collateral for the money which we are getting from the bank. Okay, this collateral in the line, it will mention that lender, bank or any lending institutions, so these type of charges we are taking as a bank. So any financial institutions or the lending parties, whom they are lending, can charge these charges for the loan they are giving. So it indicates that they can sell the property and they have the full rights over the property. It will be written that bank can sell the so and so, for example, if you take can sell this property if you have not paid, like that in document they will be writing, um, when we take the loan at the time itself it will be ready. So if we are not paying it at the correct time, they will simply, with this help of this document, so they have the right, so they will sell it off, and they don't want to get a permission or anything. Okay, that is line. Now we will see what is assignment. Assignment is nothing but when you have some property or any documents in your name, you are just transferring it to your wife or husband, or transferring it to your son or daughter in a written agreement that this property belongs to so and so, or this loan will be repaid by my nominee, or my wife or husband, or my son or daughter. So you are assigning some when you are assigning some property to the other person in a written document, we will say it as an assignment. Now we will see what is set off. Set off is nothing but this happens when any financial institution, so here all these are not applicable only to banks, so any financial institution or any lending parties. Okay, this set off indicates that when we take a loan from any financial institution and if we are not repaying it, they have, that is the bank have the rights to seize our savings account or the current account or FD, RDs, or any deposit we have, if we have done in the bank. It can be in the form of certificates or money market investments in the bank. Okay, so these accounts, they can seize and recover the money when we are not paying it to the bank. So this set off indicates that bank have the legal right to seize the this customers or the borrowers account balance. Okay, this customer's account balance in the same bank to recover these loan pendings. um, or when the bank find it as this borrower is a default. Suppose you say you have 1 lakh loan in the bank, when you are not repaying it. Okay, you are not repaying the interest or the principal amount, but in the account balance you have some 10 lakhs. So the bank will identify that this borrower is a willful defaulter, he has the money but he is not repaying it properly. So what he will do, he will just take off this 1 lakh amount from the deposit which you have in the same bank. Okay, from some other bank it can't take. If you have the account in Indian bank, and Indian bank, in the account you have 10 lakh, and in the same Indian bank you have taken 1 lakh loan, so it will take that amount from your account. Okay, suppose you have the 10 lakh amount in the Indian bank and you have taken a loan from a Canara bank, so this money cannot be recovered because you have the account in different bank and you have taken loan from the different bank. Okay, these accounts, no, they are recovered from your accounts. Okay, but the sub account balance cannot. If you have the sub account balance in the bank, we cannot recover the money from that sub account balance. Okay, in our FDI video we have explained what is sub account. If you want, just go and see to it. We have the link in the description box. Just see to that. Okay, I think you might have enjoyed this video. You might have understood this small topic about bank charges. If you have any queries and doubt, or if you want any other topic to be explained in our video, just mail to us. Our mail ID is makeitsimple.0105@gmail.com. Press the like button and share with your friends. Mainly subscribe to Make It Simple channel so that you can get the notification on our further videos. We'll meet in the next video. Until then, bye bye.